Let's get to our next guest. Kathryn Rooney Vera is the head of research and also chief market strategist at Bull Tick Capital Markets, live out of Miami, Florida. Kathryn, great to see you. Hope you're keeping safe where you are. Got to ask you first about the situation in China. How much of that drove a bit into safety and into bonds? Because I know the entire curve lifted, floated down.
Absolutely. And unrest in China, which could very well, at least from my perspective, be a binary event. If it were to fall on the side of additional repression and force a government encroaching even further on the limited rights of the people in China, then would cause a ripple effect in the markets. And we saw that today. Certainly the flight to quality would result. So we're hoping for the best, but planning for the worst in the event that were the case in China.
And that's the thing, right, Kathryn? I mean, the things to watch for in terms of developments on the ground is whether or not these protests, is it just a one and done or a couple and done, or does it have legs? Are we going to see more erupting? And also, probably more crucially, how the government responds.
Yeah, you're right. And you were talking previously about the social contract. And that's been the case for a very long period of time, pre-COVID. It's, there's human rights repressions by the communist government. But the flip side is that I have a job, or there's stimulus. My life is okay. But once people have their rights infringed upon, they don't have a job, or their life is worse off, then revolt ensues. So I'm not sure that she is someone that will back down in front of this type of forced kind of pressure. But hopefully he does decide and conclude, which I think we all agree, that zero COVID policy is just not in the realm of reality. And it's really a self-inflicted wound on his own country more than anything.
Indeed. Kathryn, are global supply chains at risk? Because this crisis is synonymous with Foxconn, it's synonymous with Apple and the manufacturing and the worker protests there. And you've got not only the China restrictions, but you've got a possible rail strike in the US. Should we be joining the dots here to inflation, and are there implications for the Fed, or is that too tenuous?
Yeah, that's the direct link from the disruption in China, whether it be zero COVID or the Chinese government clamping down on any type of free speech or, uprising. The impact could be felt on a global scale because of, as you mentioned, the supply chain distortions, which have been one of the principal reasons contributing to inflation. The issue, however, in many countries, especially in my own, it's a demand issue. So recession is already in the works here in the United States. A further retrenchment in China, which is de facto already in recession, would just cause additional pain in 2023, when recession, in my view, is already in the offing. So combine that with further supply chain distortions, combine that with the potential for a rail strike here in the United States in front of Christmas, in front of the holidays, in front of people, already facing double-digit food inflation. And on top of that, you put a rail strike. Well, food prices are going a lot higher. Thanksgiving was expensive, but Christmas dinner could get even more pricey.
Indeed. Kathryn, so what do we do with this information, particularly in the bond market? Do we overweight bonds, especially short duration? And turning to Wednesday, and Fed Chair Jerome Powell, major policy speech, could be the very last one before the blackout period. Is he going to shift the narrative, or has the market already made its mind up in terms of moderation in policy?
You're right. I think he's going to try to walk that fine line. But for me, maybe the most important data point of this week, Powell's presser on Wednesday, important. Friday's non-farm. I'm looking at JOLTS on Thursday. Job openings have to decline before unemployment really takes that jump higher, which I expect it will. So I think that how we need to be positioned is, look, fixed income is back. So this is a forgotten and beaten up asset class. Everyone has been looking at equities. There is no alternative. Now there is an alternative, and that alternative is in fixed income. You can do it. You can do 3-month T-bills. You can do a 12-month T-bill. We're talking high-grade paper, in this case, risk-free assets that are yielding, in some cases, north of 5%. So I think that's an attractive alternative. I would stay short duration for now. Going into 2023 and through the course of 23, I think we should start accumulating fixed income and longer duration. As the narrative switches from inflation to recession, from how much is the Fed going to hike and what's the terminal rate, which is the question everyone's asking each other, then it's going to become at what point does the Fed start cutting because recession's so bad, because unemployment's at 6-7%. So I think we need to be in front of that with fixed income instruments.
And the kind of odd situation we find ourselves in, no, Kathryn? I mean, when cash or cash equivalents, you're talking about T-bills, is starting to look pretty good with the kind of yield they're throwing off, right? You mentioned the terminal rate.
That's right,
are we talking 4.75, 5 and a quarter, or where? And more crucially, I guess, come December, the last FOMC of the year, market is pricing 50. Are you?
Yeah, Martin, I think those are that's kind of consensus now, 50, and that's what the Fed in its own dots plot projected it was going to do. So there really shouldn't be a surprise when the Fed does 50 basis points. We've seen the maximum, the highest hike has been 75. We're past that. We're probably at 50 in December. We probably go to 5.5 in the terminal rate. But I think the bigger call now is how quickly, historically, and projecting out, how quickly can the Fed, how quickly can that pendulum swing from the last hike to the first cut? And if you look over the past 14 monetary policy cycles, the average is 4.5 months. So that can be quicker than a lot of market participants are assuming.
Oh, 4.5 month average.
Kathryn,
okay.
Thank you for that. We will get back to you later on in the programme for more. Kathryn Rooney Vera there. Welcome back. Let's get back to Kathryn Rooney Vera of Baltic Capital Markets. Kathryn, corporate credit, how do you approach it? And are credit spreads looking relatively stable right now? Is there any reason to be worried about default risk, credit offence, or financial instability? We've seen the FTX saga. Is that washing out, or is there more collateral damage to come in a higher rates environment?
Usually in economic cycles, when you're moving into recession, you get a wave of high yield defaults. We haven't had that yet. Probably the reason is because it's a small percentage of the high yield market that actually has maturities coming due in the next year and a half. But I do think that we're in for something. Triple C or single B, low investment grade junk bonds are likely to see some difficulties financing or repaying back their obligations. So I'm recommending that we stay in high grade. If you're going to be in the junk world, do it in the better quality names. But I prefer investment grade corporates. I think there are some attractive opportunities there. And as I say, fixed income has really sold off significantly. Yes, it's retraced in the past month, but there is still value to be had. And I would focus right now on short-term paper, investment grade corporate, and even look in the treasury market.
Kathryn, talk to us a little bit more about short-term paper, right? If you're talking government paper here, say T-bills, I think you threw out the number 5% or so. That is comfortably in excess of the average yield you can get in the stock market, right? My question to you is, you also threw out an interesting stat. You said the average time between, in a Fed cycle, the average time between the last hike and the first cut is only 4.5 months. And in some cases, it's as soon or quick as 2 months, right? So this play on government paper like T-bills, there is a window. When does that close is what I want to know.
Yeah. And that's timing is the real difficulty with these calls, because it's easy to say, right, that we're in stagflation now, we're going into recession. But when and how long is that recession? So these are the questions that a lot of our clients ask. And what I would reply is that you do have that 6 to 12 month delay on the impact of the rate hikes onto the real economy. Here in the U.S., we have a housing recession, and the U.S. consumers' net worth is principally tied to their house and their 401ks. 401ks, IRAs are down 25 to 30%. 60-40 portfolios are out the window. Everything's down so far this year. Housing markets are collapsing. So get the double whammy of rate hikes taking effect in first quarter, second quarter of next year. You're going to get a whammy you're going to get some impact on the U.S. consumer in an economy that's 2/3 based on consumption. We haven't yet seen consumer confidence collapse. I'm specifically referring to the conference board, which is attached in an inverse relationship with the unemployment rate. But my bet, Martin, is that once unemployment jumps, we're going to be mired in a recession. I bet the Fed, in that event, if we get a recession, if the unemployment rate jumps from 3.5 a month ago to 5, 6 by the end of next year, the Fed's going to cut by the end of 23.
All right, and short-term paper's going to be looking a lot less attractive. Understood. Okay, Kathryn, listen, we got to go. Great to talk to you. Appreciate the time. Keep safe. Do it again very soon, I hope. Kathryn Rooney Vera from Bull Tick Capital Markets joining us live.